Hello, Brandon Chapman with you today. This May the 4th be with you. Got a little list there. Anyway, it's May the 4th, and boy, it may take some force, but unfortunately, the force of Jay Powell and the Federal Reserve, it appears there was a vote of no confidence today after they raised rates a quarter point after we're told the banking system is sound, because banks are, in fact, back in the spotlight today. So we'll kind of look at what's happening in the bank, unusual option activity that's affecting the banking sector or playing the potential impact to the downside. And we'll look at some other stocks, maybe in the energy space, and some bearish interest sneaking back into gold, and maybe talking about why that's maybe materializing at the moment. Anyway, so as we look at the S&P, these are the futures. We're down 0.75% with about 2 minutes to go until the close. Things could have been a lot worse. Companies like, for example, PacWest Bank down 50% today. Companies like, for example, WAL, Western Alliance, down 38%. Banks like U.S. Bank, for example, only down 2.6%. Bank of the Ozarks down 3.6%. This was something on Tuesday. I spent my session walking through a lot of the bearish option interest creeping back into the market before the FOMC policy statement yesterday, where they raised a quarter point. And you saw bearish interest in things like ACRE, SLG. We're talking more the commercial real estate side of things, but also in companies like Zion, right? Zion's National Bank down 12% today. Again, PACW, like we talked about, WAL, Ally as well. I mean, just the consumer finance space or financials, specifically more regional banks, even Synchrony Financial, all these companies really saw significant bearish interest come in. And it was curious. I'm like, well, what's the Fed going to do the next day, right? I'm like, are they going to raise rates? In essence, what Powell came out and did is he did a bit of a hawkish tightening. The statement seemed to be more balanced, but during his Q&A session, he really addressed the inflation concerns, the potential that they're going to be data dependent, but not really in a position where they're looking to cut rates. And shortly after, 2 hours after his Q&A, we really began to see companies like PACW, just after receiving that confidence that everything is secure. I'm going to go back 5 days here. Everything's secure. All of a sudden, we began to see things break way in a very significant fashion. Are they seeking people to buy them? Powell talked about the fact that FRC was sold in a competitive bid process, that JP Morgan bought them. Again, he assumed it was the FDIC conducts this. But the idea being is that, hey, nothing to see here. In fact, he even talked about his about the reverse repo. We're talking about over $2 trillion rolling over day after day after day. And this began to ramp up just shortly after kind of a regulatory change in March of 2021. And we're kind of shifting some of that capital moving away from the banking system towards something like the reverse repo facility that Fed has put up right now. And they've yet to take it down. And now it's the function of we're not relying on banks. Capital flows are going out of banks towards higher banks, other areas of the market. And now we're all kind of in a pickle at this stage, wondering what's going to happen. And yesterday, Powell talked about the economy. And when asked about recession, saying he doesn't think we're going to go into recession. And yet, the people they employ to do this analysis suggest that's potentially the base case here. And when you look at the bond market, for example, TNX, I'll bring that up, and we'll look at the yield curve. The fact of the matter is, the bond market is telling a very different story, right? Let me see. Show price to percentage. No, we don't want that. And I'll flip this to a 1-year daily chart. What you're seeing with the bond market is the Fed raises rates. We're diverging from longer term rates, 5, 10, 30 year. We see this kind of 3-month T-bill and 10-year Treasury note yield. We're currently at about 1.7% difference. This is a very, very, very inverted yield curve that we're experiencing right now. And that kind of 3-month and 10 inversion happened last November, kind of touched on it back in October. So the idea is that you start to experience this stuff, and we're talking normally, and maybe a year, 9 months down the road, you're typically finding yourself in recession. And yet he's suggesting that it is, to quote, it is different this time, right? That somehow the forces involved are going to lift us out. And if we do enter recession, it's going to be relatively mild. But the fact is that this is a real concern. And what happened shortly after he spoke, we're back into this mire of potential bank failures again. And again, how do we recognize how to move forward in a climate where we're seeing such pressure on financials? Financials, the second worst performing sector today. And with all this in the backdrop, we also have Apple announcing today. Apple, we saw some warnings yesterday from Qualcomm about weakness in the smartphone industry. We're wondering, where do consumers stand right now? So we go back to Apple. How much of Apple's business is centered on consumption or consumers generally speaking? If we come in here on the Thinkorswim platform, look at the Trefis estimate, you notice about 70% of the company's businesses are services and the iPhone. And so being the largest market cap stock and having the most dramatic impact on the S&P and all these other areas, we have a situation developing tonight. We've already seen the weakness in financials. Certainly had Apple down 1% today. Technology was down about 0.5%. It's been holding up relatively well. But in the backdrop of this, what if Apple misses? And so again, what if they downgrade guidance? What if the response to Apple is relatively negative? And this is something that could really start to turn as Apple being kind of a bellwether for consumption, right, in the United States. Notice that utilities are up about 0.75%. Real estate up about 1%. Real estate is on a tenuous perch right now. But if yields continue to fall and prices continue to rise, we generally expect to see what? We'd generally expect to see, and I guess TLT's a little bit of a mismatch duration-wise, IEF's a little bit closer. But if we continue to see a surge in treasuries and a falling yields, this does in the interim support utilities and real estate, assuming we don't see things crack. And that's a real concern right now if we do continue to slide to the downside. But over the course of the last week, there have been some significant trades in TLT and really kind of pointing to the fact, does it look like the Fed's going to cut? From Powell's statement himself, and I've got a small position in this one, but out here we got 200,000 contracts. This is mostly built over the last week, buying the 130 call, selling the 135. What this is telling you, they're expecting the TLT to run to 130, 135. Now, granted, this is a low probability trade that would actually happen, but given the pricing, it sure seems like someone feels like the pricing is underestimating the fact that the Fed may reverse field. And we talk about the vote of no confidence. He's basically telling us yesterday, interest rates are going nowhere. And yet, take a quick look what happened today. So we're going to look at the CME Fed Funds futures, and we're going to look at June. June is pretty much at this stage a foregone conclusion, if I can get a load here, that there's going to be no cut, right? We're 5.25. That's where we are today after yesterday's rate increase. But then we start to look at July, the next meeting, the end of July, July 26th. And all of a sudden right here, we're looking at 56% and 2.6. Just add those together. We're basically 59% probability the Fed is going to cut a 1/4 point, and that's by the July's meeting, by the way. And this is a relatively large shift, right? A week ago, 21%. Today, 56% probability of getting a rate cut. And again, this is right after yesterday, Chairman Powell was talking tough, saying, look, we're not going to cut rates. We may have to raise rates. We're going to be data dependent, but we are going to kill the inflation monster. And again, the banks kind of rearing their ugly head. Again, you're seeing the pressure being born in the market saying, you know what? I just don't believe you. And some of the trade we're seeing in the bond market like this is certainly reflective of the Fed potentially cutting rates. And I say potentially because there is no certainties, right? If you're looking around for certainties, I just don't have them for you, okay? But we began in my sessions, we began this kind of bullish bias in TLT actually the week of October 17th, looking for a rally getting to the 61. We've been consolidating ever since, but this is likely the first leg in a very significant, potentially significant rally. The next, if we break out here, 120, we break 120, we're looking at 140. We break 140, we're looking to 170. Now, we have to kind of lay out what might be happening in interest rates here, right? You get a couple of cuts, we may find ourselves pricing in more of a deflationary future, driving interest rates even lower for the 30-year treasury yield, because this is 20 plus year for TLT. And boy, we get back to ZERP. Could this be a 170? So the idea is this could potentially be a very low risk, maybe you got to risk 15 points, high reward if the Fed in the coming year or 2 years goes back to zero interest rate policy. And as we've seen in the past, these bearish turns, right, these dovish turns in the Fed can happen very quickly. Look back at 2018. The Fed raised rates for the very last time, quickly began to reverse as they saw the weakness in the market. And they began to get dovish, and eventually in 2019, lowering rates. And you can kind of see what happened. We went from about 112 up to 170s, went back to ZERP in 2020. So again, I think it's one of those things where you can look at Jerome Powell. You got to look at the statement, and I understand they probably have to maintain their credibility. They can't just turn face and backtrack. But I thought one of the more telling statements from yesterday was the fact he talked about, someone asked about what lessons have we learned from the banking crisis so far? And you say, what banking crisis? Just realize that in 3 bank failures, we have had that represents more assets than all of the 20 plus banks combined during the great financial crisis. And folks, we're just getting started right now in terms of this potential crisis that's developing. And essentially Powell said, what lessons have we learned? Basically that, the sell-off can happen a lot more quickly than we thought. And again, when you look at PacWest, I think this is something where, things are happening so very quickly. And when we say it's happening faster than we thought, just think about here, literally within said everything's secure. Oh, we're doing good. Literally within a couple of hours after his Q&A, we're now repricing in a PacWest Bancorp default. And so on Tuesday, I spent a bit of time going through these banks and the bearish trades on these banks. And again, looking at the potential downside in the near term. And again, it kind of proved that the option flow into the bearish side of these stocks certainly was anticipating and helping to create the gamma squeeze to the downside in these bank stocks and consumer finance stocks that we took a peek at here. And boy, you look at it today, this is just a scan that I have here, but just focused on financials, WAL, right? Western Alliance, that put option from yesterday to today at the 15 strike, up 2,200% on that option. And again, we look here, FHN, PacWest, Wells Fargo, 35 puts in here. So you can kind of go down the list and see, wow, there's just a lot of breadth to the put interest. And I have this set up. I'm just looking at puts for the moment. Now, the contrast here of the bearish activity or bearish interest in these particular names, likely a lot of shorts as well, right? The contrast here is what's going on with KRE. And certainly KRE, if those continue to sell off, should continue to sell off as well. This is an ETF that does track regional banking. What I thought was interesting today, though, there was a lot of significant bullish trades. And I'm not really saying, look, that we're expecting everything to turn around, but there is that possibility, right, that the Fed comes out with their bazooka and does something. The bazooka is something that Bernanke and Paulson talked about in 2008, 2009, but they come out with their bazooka and try to really impact and force a short squeeze. And so what you see with KRE today is there's some trades out there trying to mitigate some of the risks. A ratio spread in here, 38.41. This actually kind of balanced out by the end of the session here, but there was a 5,000 and 10,000 ratio spread, buying the 38, selling the 41, kind of expecting a bit of a squeeze here back up to those prior lows. And there was also a similar one that occurred in the May expiration as well, a ratio type spread. Again, looking at, in this case, 36, 39. We got 36 and 39 in here. So the idea is we're buying the lower, selling double the higher. Again, trying to make money, 239, not expecting to go through it. But then you also couple with other areas where you're seeing buying interest right now. And again, this was actually the May expiration. at the May 42, 44 up here. And again, you can kind of see this stuff when you get down into the time and sales. You can see these big trades in here, right? 40, 43, 42 and a half, 44 for 19 May. So again, a lot of bullish trades and carry. The only thing I'd probably say is that, this is hedging a lot of the negative, the bearish interest, negative expectations for the broader regional banks. They're probably using this product to say, hey, we got to hedge ourselves in case the Fed comes out with the bazooka and maybe this has a chance of jumping back up. Whereas some of these companies like a PacWest, maybe they don't. Maybe they stay down. They do go into some sort of receivership or something. Who knows? The point being is that it looks like there is some hedging. And this is where things get dangerous as a trader, right? When everything's kind of on the table, likely, saying, look, we're trending. We don't know the outcome of all these banks and what's going to happen, but we do know that it's significant. It's rearing its ugly head again. And this may prompt regulators to step in, and this may help create the short squeeze here. So if you are shorting stock in some of these banks, be careful. The volatility is extreme right now. If we look up here, 100% vol for the week. You look at PacWest, we're talking about 1,000% vol for tomorrow, 900% for next week. You look at Bank of the Ozarks, again over 100% vol. Even again, some of these consumer finance stocks, like a Comerica, close to 200% implied volatility. And in all these, we're seeing bearish activity. US Bank, over 100% implied volatility. And this is really, really high. So just realize there is a lot of risk, getting shorter. So if you are going to get short, certainly spreads, out of the money put spreads here, low risk, high reward as a possibility if you're trying to play the downside. And again, you could even look to take some upside in KRE, right? Balance it out if you want, because, there's a chance that some of these other banks may continue down while KRE may goes up a little bit. So it's hard, Also another area I focused on was Macy's, and Macy's continues to see a decline. We've seen continued bearish interest here over the last several weeks. We broke support today. If I bring up the volume, you'll see we had significant volume today as well. Today on this one was a roll from a June 16 to a June 15. And so the idea is we have earnings coming up here. Again, Apple may really set the tone for retail. XRT on Tuesday as well. Actually on Wednesday rather. I reviewed a number of these trades yesterday, down 0.5%. We're looking to potentially break support and retest your lows at 55, 56. So what we need to really focus on in the next days is what's happening with financials, specifically regional banks, and then the spillover into the broader retail sector. Again, the outlook from Apple could be a big key to that. But a lot of these consumer finance stocks like Ally, for example, ALLY, Capital One Financial, we've seen them break down in the last week. Again, oversold for the interim, but definitely if we look for that bounce back, look for that rollover again, right? These things are likely to set up on the bearish side again. It's just a matter of when. Now on this front, gold has done really well. Gold's had a nice few day rally here. And why is gold rallying? It's really simple, right? We could get really kind of like trying to overcomplicate things, but gold is rallying because the dollar's going down. The fact is the Fed yesterday being kind of a hawkish rate, kind of a hawkish pause, the idea they raise rates and pretty much indicating they're probably done unless the data tells them otherwise. I'm not sure what lagging data point they're going to be watching there, but the realities of this is saying, look, there's some estimation, and you're seeing that in the Fed fund futures, that the Fed has basically made a policy error. And what that means is that, yeah, they're tightening now, but they're going to have to ease a lot more later on. And so as a function, we've seen dollar weakness. So that's kind of my thought process. The dollar declined yesterday in UUP, mostly against the euro. But the idea is, and this kind of plays out sometimes in the currency markets, is that, okay, they made a policy mistake. They're going to have to ease a lot more down the road as they maintain this more hawkish stance. And so as a function, despite the fact they raise rates, the dollar gets sold. And in real terms, looking at GLD, they move higher. Now, if we continue to see this initial selling right now in the banking space, and we don't see the bazooka from the Fed that's going to create this kind of inflationary environment again, or try to create an inflation environment that may lead to stronger gold prices, do they hold off a little bit? Recognizing right now is that anything they do at this moment is going to end up kind of reducing their credibility. There's this notion if you have a string and you exert force on the end of that string, the string just coils up. And this is the problem where the Fed is right now. They are in effect pushing on a string. And if you've got a bazooka, you probably wait for the army to show up. And this may require more weakness than what's being priced in right now. And we may see banks sell off more. We may see that contagion spread a little bit before they really step in and decide that they're going to do something significant. So what does this mean for gold, or in this case, gold stocks? For gold stocks, the issue becomes that, look, we're at resistance right now. We've had a nice run. There is the risk that the dollar does begin to surge, right? If we start to see not just the liquidity issues start to percolate, but actual solvency problems, which the Fed cannot solve, by the way. They can help with the liquidity in the short term. Solvency is an entirely different matter. If we start to see solvency issues rear their ugly head, this could be very positive for the dollar, since a lot of debt is denominated in dollars and demand generally picks up. That's why the Fed, the last kind of swoon we had in the banking space back here, their balance sheet expanded like $400 billion. They engaged in currency swaps with other central banks, trying to provide significant dollar liquidity. But there is a point where even the liquidity may not be enough, as more capital is destroyed than they can try to create out of thin air. And I use the term capital loosely for a reason. Now, at resistance here. So what we saw today, and one thing to watch within gold, do we start to pull back as the dollar, in fact, potentially strengthens? And as we look at the July expiration here, you're seeing 5,600 contracts mostly bought. I didn't have a chance to evaluate the 4,000 there, but you're seeing some bearish interest come into GDX. Make sure it's not a spread. I didn't think it was, but maybe it is. Yeah, 15 SEP, 50, 40. It's on the call side, and it's probably closing it out. But July 33. Yeah, I'm not seeing it's tight anything. Yeah, so, but the idea being is that, again, is there the potential? I was looking on the wrong side. Is there potential we start to see gold pull back here? And so this is kind of an indication. Maybe don't go short, but maybe decide to if you've been long gold the last week, take some profits here. Yes, the upside for gold and gold stocks is potentially very great as we come over the next 6 months or a year, particularly if the Fed begins to cut rates. But just be careful here in the short term. Last little note we'll kind of make today is for oil. Oil, surprisingly, right? Oil's been dropping. We saw a big drop today, testing 65, rallying off of the lows. Oil still remains in backwardation as we see prices falling in the future, which is bullish. It shows kind of a potential shortage. We've seen draws in oil for the last number of weeks, and yet we've seen concerns over recession and basically the shorts coming in, driving down oil prices. This has had a very negative effect on energy stocks. And again, you look at today, one of the worst performing sectors. If oil can hold on to that 65 level, does this start to open up the possibility for companies like, for example, a Denbury, right? We're under pressure today. We just had earnings come up. We've had kind of a smattering of earnings. BP was fairly negative because of their hedging basically made the money. That was about it. Be it Exxon produced substantial profits. Didn't exactly save them, and we're a bit oversold. But the reason why I'm bringing up Denbury and MRO, this was a day we started to see some bullish interest start to wade back into these stocks specifically. And for Denbury, it was a June 90 and 100. So again, we're not shooting for the moon here, but by June, we're looking at 90, 100. Do we see a bit of a reversal happening in the near future for some energy stocks or energy generally, specifically producers or more integrated companies? MROs had an ugly little turn here, right? Earnings came out today. Stock didn't go down a lot per se, but again, you did see bullish option activity come in. It was a 12 May 23 strike, so a little bit out of the money. Probably look for a break above the high of the last couple of days, and we may see a run to maybe 25, testing prior resistance. So a little bit of a bullish trade perking up in energy. And I'm going to wrap things up, I guess, with Bank of America. I didn't really go over this one. But is there the possibility that we've seen the weakness in the regional banks, the liquidity problems? Do we see it start to move uphill to companies like Bank of America? Bank of America is a big money center bank. They're also a company that, if I remember correctly, we talked about Silicon Valley Bank. This is the second bank when you go in the order of the amount of equity lost through their treasury holdings. And this is a big difference from the financial crisis at this point. Other times, a lot of the liquidity problems for these banks are outflows because of their treasury holdings. It's not default, it's the fact they've sustained significant losses on those holdings. And unrealized losses, loss-wise, I believe Bank of America stood about 40% of equity back here when Silicon Valley Bank exploded. So interestingly enough, we did see 3% down movement today. We do have support kind of around this 2750, maybe extending to 2620. But does Bank of America start to break way, and we start looking maybe 23, possibly 20? Certainly today's activity is looking at a weekly option here, 12 May at 27. So we're right around that level. Again, do we start to take out this level that's pretty significant around 27? And does this kind of create kind of a cascade of selling as we start to look at the more finer points of the big banks and potential issues that they may be having down the road? And so this is one of those days where, is there a lot of stuff? There's a lot of desire to commit capital, but I do think it is one of those days where there are some setups here, maybe in the bullish sense. We kind of talked about a hedge in KRE, talked about MRO, Denbury, but also the chance that you could potentially put an out of the money spread on some of these bank stocks. And again, you can go bullish on KRE and kind of do which one's going to break first, right? But anyway, it's been a pleasure being with you today. Volatility is potentially on the rise, and so again, you got to be careful at this stage and keep your head on a swivel. Anyway, it's been a pleasure being with you. Thank you.